everyone. Hope you're doing well today. This is Drew, and I am here with John Creekmer. And today we are going to have a deep dive where we're going to provide some context and perspective around what we are tracking and seeing in markets and in the world at large. But John, before we do that, how are we doing today?
Doing great. Actually, I was honored with a phenomenal award. I show everyone right here. So we had the first annual Creaky Awards, and just so you know, I received this incredible award for being the boss of the year. And so I'm not sure how the voting went on that, if people were concerned about paychecks the following week or what it was, but I feel so honored with receiving this Creaky.
Say that's awesome. What a cool new tradition we're doing. Love that.
Right. So, that was quite an award ceremony, though. I mean, the kids got all dressed up, and we had a red carpet out with names on it and stars, so it was kind of funny. But it was a good time for sure. Good time for sure.
That's awesome. Well, hey, we want to make good use of everyone's time here, so let's kind of dive into it. And we're going to walk through a number of charts. But I think it's important to provide some context around these before we dive too deep. And, I think patience is something that we are all struggling with in this moment in time. It feels like it's things are just plodding along, not in a great way. But we're actually starting to see, Johnny, you've used the phrase in the past, green shoots. We're starting to see some positive movements in areas that are really key for things to kind of settle down. And so let's kind of provide some perspective about the road we have been on so far this year, and then we'll kind of go into what those green shoots are. And so this first chart, what it illustrates is the performance of the S&P 500 through the first 169 trading days in any given year. So what you see here in the middle column is that so far through those first 169 days, the S&P is off to its fourth worst start in history. But John, I think you really made a good point. We were talking about this earlier, that the really important column to pay attention to is, yes, the year's been rough, but it's that middle column there that is very important to keep in mind.
It is. A lot of it is, I think that we've had the last, we'll just say 2.5 years. There's been just so much instability politically. There's been so much instability just from with the COVID virus and how do things go from there. And so a lot of it is that people are just kind of getting tired of all that. And so it becomes easy to make emotional decisions without looking at facts and kind of seeing where things are at. And so I love your phrase there, Drew, patience makes the most sense. And so you're exactly right. But look at the first 169 days of a trading year. Here, number 4 is 2022. S&P 500 is down 17.7%, the fourth worst start to a year. But whenever we look at all the previous years in which it was a negative start to the year, look at that price return day 170 to the end of the year. 1974, as I have this, is the worst start to a year, 26% down. Then it was down 5%. However, of the top 9, that is the only year that was negative from this point forward throughout the rest of the year. So a lot of it is saying patience in the moment and making sure we have strong strategy, paying attention to the things we're seeing under the surface and letting things kind of play out.
Right. It's one of those things in the past you maybe could have put some money in bonds. But I think this next chart kind of illustrates why we have actually encouraged a lot of our clients to move money out of bonds or fixed income and to utilize those buffered strategies, which we've been incredibly pleased with. But it's the worst start to a year for the 60-40 portfolio, in large part because of how much bonds have struggled and how they're so positively correlated with stocks currently. And so we are seeing rough period in time here, but when we look out and look at history kind of as a guide, we see that there's some positive reasons to stay patient as long as you are continuing to execute on a good strategy. And John, you've lived through and worked through with clients through a number of those periods. What has your general advice been to people whenever you're going through times where it just feels like, man, I can't see any sunlight at the end of the tunnel?
Yeah, it's one of those things to recognize that all things come to an end, and at some point we do revert back to the mean, and not to get frustrated just with the journey, but also you want to make sure that you understand what your goal objectives are. And so if the goal objective really is we need some funds on a monthly basis, or we need some funds 6 months or 12 months down the road, well, then your time horizon is very short, and so you want to make sure that your investment portfolio is structured accordingly. At the same time, if your horizon for some of the money is not to be touched for 5 years, 10 years, 20 years, then you want to make sure you're positioned properly. One of the key things that we really have been focused on in the last couple of years, we really surveyed a lot of our clients to find out where they're at, to find out what things, services and products and tools that they need. And we surveyed about 700 clients at the end of last year. And coming out of that, there was a number of great areas of feedback that we still appreciate from everybody. But one of those was, what do we do in an environment in which things kind of seem upside down? And so you mentioned buffers. We brought buffer strategies on about a year and a half ago. It's provided tremendous balance in accounts. We still have upside growth potential. We also added in structured notes that have a stated principal protection and dividend payment. We brought in some IO real estate funds that are not correlated to the stock market. We've added a high interest savings account, which is paying significantly higher than market rates with full liquidity. So it's always looking to say, in this environment, not all things go down in any environment. As a matter of fact, you can find opportunities. It's a matter of finding opportunities and aligning the opportunities with the goal objectives. So a lot of it, Drew, is making sure things are properly allocated.
Yeah. And John, you just kind of rattled off a bunch of new tools that we have, and I'm sure we've talked about them with a lot of you. But one of the things that we've always encouraged our clients is during these periods is to check in with your advisor. Have a 15-minute strategy session. If you heard something there where John said, hey, the high yield savings account, that sounds interesting to you, give your advisor a call and ask the team to set up a meeting with them. We are more than happy to walk you through the pros and the cons and making sure that you have the right tools in your tool chest to help you stay on path towards your goals. Now, John, let's kind of shift gears a little bit and let's talk about what is the biggest topic from an economic standpoint, both here in the U.S. and globally, and that is what is going on with inflation. We have seen a massive increase in inflation recently, but we have some charts here that we're going to pull up on the screen. I'll let you walk through that's showing that we're seeing positive signs in inflation actually starting to come down a little bit. And so can you kind of walk us through just what we are seeing in these charts and inflation in general?
Inflation is huge. We're all realizing it in different ways. We have seen some relief, especially in unleaded gasoline prices, and yet diesel is still maintaining the same very high price. It's elevated around $5.65 a gallon as far as nationwide. So we are seeing some relief in there. But I know we started out college football season, and a lot of our clients love college football, and we hear stories of going tailgating. This will kind of keep things in perspective. The average cost of a propane and or wood is up 22% year over year. So if you want to grill out your hot dogs, and speaking of hot dogs, they're up about 9.2%. Chicken's up about 21% year to date. And so if you're sitting there thinking about your tailgate, it might be a little bit more expensive this year. But hold on. I mean, we're seeing some positive things happen. And so one of the things historically to look at is to say, well, let's look at recession. Let's look at CPI. And then let's also look at the Fed funds rate. And so we know inflation hit a real high about a month and a half ago. And since that period of time, it's actually started to slow down. So inflation is still going up, but not with as fast of a pace. So we're going to dig into a little bit as far as what's happening there. So we know the Federal Reserve has increased interest rates by 0.75% twice. Today, the Bank of England actually has increased interest rates of the Bank of England up to 0.75%. It took it off a 0% rate. So we're seeing a concerted effort across the globe of countries trying to get inflation under control. Fed Chairman Powell came out and said today that the issue in the 70s and early 80s was that they actually didn't kill inflation. They allowed it to kind of percolate under the surface. Right. So their main focus of the Federal Reserve has been stated that what they're really going to try to do is just totally kill inflation. Now, with that, though, comes a consequence. And so what they've done is they've actually stopped buying bonds. So they've slowed down the bond buying program. But secondarily, that actually put cash into the system. And so we know that the economy starts to overstimulate when there's too much cash in the system. So we're seeing M2 actually decrease, which is a measurement of money in the system. The second thing that we've seen the Federal Reserve do is increase interest rates by 0.75 on two occasions. We're looking here in about 2 weeks for the Federal Reserve to increase again by another 0.75 and potentially again in October by 0.5 to 0.75%. So by doing so, what that is doing is it's actually slowing down the demand for money. And so people are not going to be buying as much. We know that mortgage rates on a 30-year have approached 5.875, on a 15-year 5.625 as far as on mortgage rates. So that has actually slowed down real estate price increases. Well, what does that mean? Well, if I cannot sell my house for as much money, then I have less excess reserves that are sitting there for me to use to turn around and purchase something else in the economy. It slows down the expansion of the economy. If people on their lines of credit, their home-based lines of credit, if it costs extra money or extra interest, then they're not going to be as inclined to go out and put the extra deck on the back of the house, not going to be inclined to buy the next refrigerator. They're going to slow down their purchases, their remodeling, their purchasing of new cars or toys. And so it's going to slow down the economy. And then in doing so, that actually puts a damper on inflation, because at the end of the day, inflation is really about supply and demand. There's a certain amount of goods and services that are there. It's the demand for those goods and services, but if the cost to purchase them is going up, people slow down their purchasing.
Yeah. And so when we look at some of those goods and services, some of the reasons why prices were up so much were just the cost of shipping, or how much gas cost for here in the U.S., or how much it costs to take a freighter in a container and move it across the ocean. And I find these charts to be just incredibly important to keep an eye on, because they generally are a leading indicator of future price relief or future decrease in inflation. This first one, John mentioned already, the price of gasoline is starting to come down nationally. And the second one is showing that we're seeing a significant reduction in the price that it costs to move one container across the ocean. And this was as of September 2nd. It's almost a week ago now. That price is continuing to fall day over day. And so while there are some bouncy things ahead of us, it's good to see that we are seeing things slow down as a direct response to the actions taken by the Federal Reserve and other central banks here in the U.S. And so, John, brass tacks, how does this impact us? Is it, what do we do with this information?
Yeah, that's a great question, Drew. And so at the end of the day, you mentioned the word green shoots. And so in other words, the things that are starting to sprout under the surface in the economy that are really those leading indicators to say where things are going. Now, it's not going to be immediate. And so it's kind of like in the springtime, and if you're in a state that has a lot of corn or agriculture or beans, you might see, as far as at the end of April, the 1st of May, a little sprout coming up. However, you don't really see the full stalk of corn with a tassel on it, and then corn on the actual corn, until we get to sometime in June or July. And so it takes a little while for it to percolate. But what we're seeing pricing, base level, leading pricing indicators actually coming down. And so that's going to be fuel. That's going to be the cost to ship containers. That's going to be items that we see as far as first level cost as far as in the entire system. And so with that, we see pricing starting to come down. We see inflation actually already peaked. Now, it may bounce back up as far as in the acceleration, but it seems to have peaked, and we show with the leading indicators that it should continue to come down. And with the increase in interest rates, we believe that's going to continue happening. So the question is, what do we do with this information? Again, keep in mind that the first thing, the most important thing is take all the noise out. And we hear a lot of people like to make some investment decisions based upon maybe their view of politics or a policy. Let's make sure that we base it based upon logic, goal, objectives, and actual risk out there. And so whenever you're walking through those things, please feel free to reach out to your advisor and walk through that. But we would say, really, let's make sure that we're continually looking for opportunities that align with our goal objectives. And so there's some things that we see as tremendous opportunities. Right now, we have some phenomenal holdings inside of our accounts that have been positioned to take advantage of value, to take advantage as far as on the inflationary things we see are still going to be there because of what's happening with the war over in Russia. And so in other words, heating oil, natural gas. We're also seeing tremendous opportunities right now as far as in clean energy. So no matter where you stand from a political perspective, the reality is with recent legislation that went through is really elevating prices of clean energy, renewable energy sources. And so we're seeing tremendous opportunities to make profits there. So we look for opportunities in the midst of any downturn. And then from there, we try to find ways to soften the negative and give our chance an opportunity to make on the upside. So align goal objectives with as far as with your investment portfolios.
Awesome. I think that's great. And we'll also plug here, I have a video walking through some of those new tools that John mentioned earlier, the structured notes, the high yield savings. That's going to be lower down in the email. So take some time and watch that video to just educate yourself on what those tools are and how they can continue to help you walk forward and towards achieving those goals. So guys, that's what we had. Hope you found this interesting. If you have any questions and you would need to talk to your advisor, reach out. We look forward to hearing from you. And otherwise, we'll keep things held down here.